is with a very warm heart that we welcome you to today's episode of Tax Matters. My name is Olumewa Matuloko. Brand new week, brand new episode of Tax Matters. But then today, we are continuing from where we stopped last episode. That's talking about our focus on company's income tax. And our guest, our guide, our teacher remains Mr. Adesina Adedayo, Chartered Accountant, Chartered Tax Practitioner. Mr. Adedayo, welcome once again to Tax Matters.
Thank you very much.
We are still discussing company's income tax. Company's income tax rate 30%, education tax 2%. What's the percentage of NIDA?
NIDA is 1%. 1% of profit before tax.
The education tax fund is 2% of accessible profit. Company's income tax is 30% of
total or taxable profit.
NIDA
is 1% of profit before tax.
Which one is that one again?
Now, profit before tax is an accounting profit. And naturally, when you look at a company, let's say a company that is into trading, the company is into trading, it starts with turnover. It takes away the cost of the goods it's selling. It arrives at gross profit. Now, there are some administrative expenses, salary cost, other costs. All those are now the other expenses that you take away after you've arrived at gross profit, which is your trading profit. Then when you take that away from the gross profit, you arrive at profit before tax. That is the profit you arrive at before you consider payment of tax obligation. So at the NIDA level, you look at 1% of that profit as a cost to you again that you have to pay. But NIDA is equally applicable to select companies, not every company. It is applicable to companies in the telecom business, cyber, internet business, banks, the pension managers, and then you have the insurance companies.
Okay, not everybody.
Not everybody. It's not applicable to everybody.
That list is on the screen. So company's income tax and education tax and NIDA levy are paid with company's income tax 6 months after end of accounting year. When is the due date for VAT? That month.
VAT is 21 days after the end of the month.
What about withholding tax?
Withholding tax is equally 21 days.
Every month. Whatever I collect in the previous month, by 21st of this month, I must. Okay. There are two kinds of companies. There are some that they call sole ownership, one-man business. Muiwa Ventures, God is Good, and Sons. And we have the limited liability companies. Which tax authority do the one-man businesses pay tax to?
The one-man business, like you said, includes, let me even expand it to include even partnership.
Okay, partnerships.
Yes.
For professionals, accountants,
exactly.
lawyers.
It still falls within the same category.
Surveyors, estate agents.
Exactly. This is guided by Personal Income Tax Act. And it is based on the state in which that individual is resident. So if you have, example you gave, like if you have a Muiwa Venture resident in Lagos running a one-man business, the relevant tax authority in this case is the Lagos State Internal Revenue Service. So wherever you find yourself, under the Personal Income Tax Act, wherever you find yourself in terms of residence, it becomes where you pay. So when it comes to companies, irrespective of where you are located in Nigeria, the Federal Land Revenue Service is the relevant tax authority.
Okay. Now, we are both residents in Sokoto.
Okay.
You have an hotel in Sokoto, but it's not operating under limited liability.
Okay.
You are Adedayo Hotel.
Okay.
Maybe the name of your wife, Lovett Hotel. I have an hotel in the same Sokoto, but it's under a limited liability cover. What is the difference between our tax liabilities? We are both hotels.
Yes. The difference between our tax liability is, let's first put something in perspective too. One, the other man who decide to incorporate it using limited liability company has created a separate legal person. That hence with that word limited. Incorporated, that's why the word is incorporated. The other man who is making it Adedayo Hotels, I only registered a business name And that's why at the level of Corporate Affairs Commission, you say registration of business name. You only registered your business to say, this is the name in which I want to be doing business. While the other man incorporated a separate entity, which is a limited liability company. That is one. Going further, you realize that one, the man who registered a business name, whatever profit comes from the hotel, he is responsible as a person for the tax liability. So it means if the hotel should make 20 million, or let's even say 50 million, the 50 million made by the hotel is going to be taxed in the hands of Adedayo as a person. And all personal income tax related rules apply. Whereas for the other man, he has a separate entity where all expenses are liable, all other benefits that goes with incorporation is liable. And secondly, you will realize that investors have more confidence when they are now dealing with a limited liability company. So for you to decide you want to go limited, you must have looked at a lot of benefits that goes with it. The issue of a business model is not only determined from a tax perspective. There are so many other issues you consider before you say, this is the model in which I want to do business. And then you get the respect to make it clear that your business will not be talking about being challenged by your personal exposure. And you know, when you are dealing with sole proprietorship, you have unlimited liability. It means whatever goes wrong with the business, even your personal estate suffers for it. Whereas for limited liability company, you are insulated to the level of the shares you have contributed. So a lot of factors goes in before you determine whether you are making it limited or a sole proprietorship. So beyond that aspect again, you now look at one, the limited liability files its return with the tax office. So that means the man who decides to go limited may have one hotel in Sokoto, another hotel in Kano, another one in Port Harcourt, another one in Lagos. All these hotels are subject to one relevant tax authority, Federal Inland Revenue Service. Whereas the other man who decide to go in terms of private listing, puts a venture here in terms of this is where he has a venture. If he has the venture still in Port Harcourt, because he is still resident in Sokoto, Sokoto is responsible for collecting tax on the income he makes from Sokoto and Port Harcourt.
It's so complicated.
It is where the individual is resident. For as long as he remains in Sokoto and is known as living, sleeping, and waking in Sokoto, Sokoto State Internal Revenue Service collects any income that comes to him.
And he has 5 hotels, like you said, one in Kano, one in Port Harcourt, it is the Sokoto where he is.
It is the Sokoto where he is that collects all the tax relating to.
We are still going to go into this on the next episode, but you don't have to answer this. As an Ogbonge, to use the Nigerian parlance, as an Ogbonge chartered accountant and tax practitioner, which one would you advise? To run my hotel as a limited liability concern or as a sole proprietorship?
I will endeavor to answer it, even though you gave me the option of not. I would rather prefer it is a limited liability company. Beyond, because one, I mean, looking further, like I said, looking further beyond the tax benefit, I see a situation, for example, let's say I want to even divide the shares among my children. It is easier for me to divide the shares among my children and then take a rest. Whereas the other one that is strictly in my name, I will be looking at a situation where I have to die, write a will, that in case I die, this hotel in Sokoto should be given to Olu, the one in Kano should be given to Ade, the one in Port Harcourt should be given to Muiwa, whatever it is. So it complicates my thinking process. And it does not even make me to be able to get the foreign investors to believe in me, because the risk is higher. I have constituted myself as a risk when I decide to make it a one-man business.
London, New York or Lagos, business or holiday, home or office. You can now carry out your tax transactions from anywhere in the world. You can now file all your tax returns, pay online, get a receipt and even process your tax clearance certificate from anywhere in the world online and in real time. All you need to do is log on to www.firs.gov.ng and click on e-services and be introduced to the world of innovation, convenience and transparency from the FIRS. You can also pay stamp duty as you register a new company with the CAC or for other transactions that require stamp duty payment online. You can also file your withholding tax returns and determine the withholding tax deducted from you is in government coffers so that you can get your receipt within 45 days as long as the deduction has been remitted. Yes, all of this and more online at www.firs.gov.ng/e-services. FIRS, making tax administration as easy as ABC. Please note that all FIRS services are free of charge. This message is from the Federal Inland Revenue Service. It pays to pay your tax.
What steps do I need to take in fulfilling my obligations as regards filing and payment of company's income tax? For example, what books and records should I keep? What kind of forms do I need to fill? What steps do I take?
Okay, let me start with what books and records you need to keep. If you remember in the last episode, I made it very clear that the taxman is blind to your activity. And the only way he can be educated or be able to know that you are not fabricating anything is for you to have your records intact. And you must give government some credit. For us to get to a level where we are talking self-assessment, it means government is trying hard to believe you that it is on the basis of a reliable record that you are now saying that this is your tax liability. And that's why it's called self-assessment. You are the one assessing yourself and say, this is my tax liability. Now the next level is this. For me to now say, okay, what you said was your tax liability is actually your tax liability. Can I have evidence of how you came about your rent? If there is no evidence as to how you came about your rent, then we have issues. And if you remember, the rule in tax is that one, it must be wholly, it must be exclusively, it must be reasonably and necessarily incurred. So if you do not fulfill those four criteria, then it means that you are giving the tax administrator the opportunity to say what you have done is unreasonable. You cannot claim, for example, you are generating a 20 million naira turnover and you are renting a 15 million naira accommodation.
Why not?
The justification between that figure and the income you are making makes it become something that requires a further test, a further inquiry. Nobody is saying you are lying. It is a question of, okay, you are staying there. Now, why are you staying in this place? It could be strategic. And then you now ask for that question. If we now so discover that the place where you now say you are using is a place that has a related party issue, then the question again is, if somebody who is not related to that landlord were to rent the place, will he pay 15 million naira? You see,
Okay.
the tax issue is not about vilifying you or trying to destroy. It's the question of, look, you say you are paying 15, but if it were to be a willing third party who is staying there, maybe the person may just pay 5 million. So the question is, why will a similar place within the same area be going for that wide variance? It puts somebody on inquiry. So that is one. Now that is why it is very important, to answer your question, that is why it's very important to have your books and record intact, including evidence of such payment. Now, talking about other things you need to do too as a filer in order to comply, you have a situation where there are some requirements. You fill the self-assessment form, which I've said earlier. And another thing I need to mention is that self-assessment form must be signed by either a director or a company secretary. That is critical. Two, you must have the audited financial statement. Your audited financial statement must have some elements in. You must have your statement of financial position in that audited financial statement. You must have your statement of comprehensive income in that financial statement. You must have your statement of cash flow. You must have a statement of changes in equity. You must have explanatory notes in areas where you think you need to give further explanation, and it must be in line with generally accepted accounting principles. Those are also one. Now, when you are not talking about payment, after you have filled your self-assessment and you have attached some documentation, which must include your tax computation, your capital allowance computation, your evidence of tax payment based on what you assess yourself that you are liable to, then you go straight to the bank, make the payment, go with the e-ticket to the tax office, and get the relevant receipts. These are the procedures. Naturally, these procedures are not so cumbersome where somebody has the willingness of heart to do the right thing. And you may need to be guided.
I may need to be guided. That leads us to the next segment, talking about roles, the roles of the different stakeholders. What is the role of the chartered accountant in all this?
Thank you very much. A chartered accountant in practice, let me be very specific, because it's not all chartered accountants. We go through some practice experience before we are qualified to even be auditors. It is not just being a chartered accountant. Now, a chartered accountant in practice, by training and qualification, is in a position to audit financial statements. Now, in auditing financial statements, it means that one, he is expected to express an opinion. The financial statement actually belongs to the company, and in expressing an opinion, is meant to be able to say, I carried out a test. By carrying out such tests with integrity and diligence, it reduces the work of the taxman. If they even decide to conduct a similar test on you, by virtue of the test that the chartered accountant has conducted, in expressing his opinion, they will find you to still be above board. And that is why it is important for a professional to handle the issue of audit of financial statement, because there is nothing the taxman is likely to ask that would not have been asked in the course of the audit process, thereby putting you on the right side of the law. So, and that is one. And then secondly, even if you happen to be an auditor yourself and you have a company, by virtue of our rules within the profession, you cannot audit your own company. That shows that the level of independence must be clear and must be apparent. Otherwise, if you say you are auditing your company, then it can no longer be said to be true and fair. In the real sense, yes, because your level of fairness would have been more or less like jeopardized, because it is your company and you are the one doing the audit of the company and expressing an opinion on the company, which is meant to be expressed by an external auditor who is independent, both in appearance and in spirit.
Assuming that my company is a big company and I have in my employment a qualified chartered accountant or qualified chartered accountants, a well set up accounts department, do we still need external auditor?
You do.
Why?
When you have a well set up accounting department with highly qualified chartered accountants, even fellows, the best they can do is to prepare your management account for you. And in preparing your management account, they would have done it in such a way, in such a professional way, that by the time the auditor comes, the level of the depth of the audit and the level of audit process will be such that it is in line with the expectation of the external auditor, whose job, I keep repeating, whose job is primarily to express an opinion. Bringing in an external auditor is to express an opinion on your financial statement, that everything that is in that financial statement gives a true and fair view of the activities of the company.
So, the accountant in your company, his role is different from that of the external auditor. Okay, I will ask a question on your behalf. If the company is not big and I don't have an accountant, I don't even have an accounting department, the best we do is keep all our receipts, record our expenses. I need an auditor. I agree. Where will the money come from? You people charge very highly.
Yes, but you see, at the same time...
You agree that your fees are high?
No, our fees are moderated and we are properly guided by the institute scale of professional fees.
And I'm a small company.
Yes.
My turnover is about maybe 6 million.
At the level of a small company, we are fully conscious of the fact that we have small and medium enterprises.
Okay.
And in such cases, at times, you see that there are situations when the same firm of chartered accountant may end up even talking about preparing accounts and auditing the account.
Okay.
The only thing that is expected is that the team that is meant to prepare the account should be different from the team that is meant to audit the account.
Okay, you still divide the roles.
Yes. Now, in preparing the accounts for you, in preparing the financial statement for you, the role of those people preparing that financial statement is technically your agent. They are preparing the financial statement on your behalf. The Companies and Allied Matters makes it very clear that the directors are responsible for the financial statement. So ignorance will not serve as an alibi. Because one, everything in that financial statement came from your transactions. And that's why you must be properly informed of every figure there. What I see in most cases is that some companies will say, I don't know anything about this account. It's my auditor. It doesn't work that way. You must know everything about your account because you are going to sign the account in the director's column there under the statement of financial position. You will sign. 2 directors are meant to sign the account, which means the 2 directors are taking responsibility for what is in that account. So even if you are assisted in the preparation, you must ask questions on every figure there to be sure that it is what you have in your record that is being recorded. Now, the next level is it goes to the auditor. The auditor now looks at it and carry out some checks by virtue of professional training, and then express an opinion. And thereafter, it moves to the next stage.
Well, what is the end product of the work of that external auditor?
The end product of the work of the external auditor is to come up with one of the items you are filing at the tax office, and that is the audited financial statement. Audited financial statement. If you check in terms of filing of return, you will see that the emphasis by the tax administrators is on audited financial statement. It is not as if you're saying you cannot come up with financial statement even prepared by your own in-house accountant who may not necessarily even be qualified. But the point is the audited financial statement adds credibility to the financial statement because an auditor has been involved. And naturally, what we have in most cases is just a document that looks like this. You see that the page, just a page, belongs to the auditor, this page. And in this page now, under the current regulatory guideline, it must be the name, the specific name of the auditor, including his status in the professional body. In this case, we say that the person who signed this is FCA. It must equally be registered with the Financial Reporting Council of Nigeria, with its Financial Reporting Council number shown and displayed appropriately. And it must also have the certification stamp. In this case, the person who did this is a chartered accountant and a member of the Institute of Chartered Accountants of Nigeria. You will see the certification stamp, you will see the Financial Reporting Council number, you will see his name and his status within the institute and the firm for which he is signing. That is the current expectation.
It's compulsory.
It is very compulsory. It is mandatory.
For companies income tax.
Yes. And you will now see a page where the directors also takes responsibility. If you move further here, under the statement of financial position, you will see that in this case, you will see 2 directors signing. It is mandatory. 2 directors of the company are meant to sign, to take ownership of the financial statement.
Why am I taking ownership? You are the auditor now.
You are taking ownership of the financial statement because the account is your account. It's not the account of the auditor.
That is why that international footballer who said that somebody did his accounts for him
was still held liable.
I don't want to mention names. You remember the footballer? He said it was his father and his financial advisor who prepared the papers, and yet they still took him to court.
Let me go further. The role of the auditor is statutory. The role of the tax consultant is serving as your agent, so which makes you the principal. And the role of the person who prepares your financial statement is equally an agency role. it means you are still responsible for whatever he prepares. So people should be very careful. And it is not sufficient to say, I don't know. A lot of people don't pay attention to what their auditors do. But by the time you see the tax office raising additional assessment, it's not going to be paid by your auditor. It will be paid by you. Because
so
you sign
take ownership from
the beginning. Every figure you are not clear with, you need to ask your auditor, kindly explain. Why did you treat this way?
You heard him loud and clear. The company owner is fully responsible for all the tax obligations of his company. That is why you are required to sign the financial statements. The internal auditor, the external auditor, the tax advisor, none of them can carry the can for you. A word they say is enough for the wise. Do the needful. Mr. Adedayo will still be here next week, and our focus will still be company's income tax.